You open your brokerage app, you see a solid 10% gain for the year, and you feel pretty good about yourself. You beat the bank, you beat the local inflation print, and you feel like you've got this investing thing figured out. But what if I told you that while you were celebrating that 10% gain, an invisible force was quietly reaching into your account and extracting 15% of your actual real-world purchasing power? Today, we are going to break down one of the most powerful, ruthless, and completely invisible wealth extraction mechanisms on Earth. It's called the dollar tide. Once you understand how this macro force operates, you stop thinking like a retail amateur staring at a localized chart, and you start thinking like a hedge fund. You start building cross-asset, cross-border protection so that your hard-earned money doesn't quietly get eaten alive by currency movements while you are asleep. Most retail investors are trapped in a one-dimensional mindset. They view their wealth through a keyhole. They sit in front of their screens, staring at price charts in a single domestic market. They obsess over daily percentage changes, moving averages, and local news. But the real financial battlefield, it's three-dimensional. It operates constantly across borders, time zones, and foreign exchange desks. The moment the Federal Reserve hits the rate hike button in Washington, D.C., the wealth of middle-class investors thousands of miles away is already being pulled into the meat grinder. The shockwave travels faster than your local news can even report it. This is the global liquidity siphon. When capital flows back to the United States and drains liquidity from the rest of the world, something brutal but mathematically inevitable happens. Your local stocks fall, and at the exact same time, your local currency weakens. That is a double hit, a synchronized collapse of both your net worth and the utility of that net worth. Your assets decline in nominal terms, and the fundamental value of the money you hold deteriorates right alongside them. Meanwhile, the large institutional players, the sovereign wealth funds, the entities that hedged their currency exposure long before the tide turned, they are just watching from the balcony, completely insulated from the localized panic. So today, we are not going to try and predict the stock market. Trying to time the exact top or bottom is a fool's errand. Instead, we're going to build something far more important, a multi-currency defensive framework. A financial firewall designed to help you survive macro turbulence and preserve the actual, tangible buying power of your labor. Let's start from the beginning. The first truth, the illusion of returns. Before we get into the mechanics, we need to address the biggest blind spot in most people's investing lives. It is a psychological trap that captures 90% of market participants, the vast difference between nominal returns and real purchasing power. Pause for a second and ask yourself a brutally honest question. Have you ever calculated your investment returns after adjusting for currency depreciation? Most people don't even know how to begin doing this. They log into their accounts daily. They see a balance up 3% today, maybe down 2% tomorrow. And as long as the absolute number of local currency units keeps slowly ticking up over time, they feel successful. That logic works flawlessly if you live in a perfectly closed, isolated economy, but you don't. You live in a hyper-globalized world where everything from the energy powering your house, to the microchips in your car, to the food on your table is priced internationally. Measuring your wealth solely in local currency is a dangerously incomplete way to view your life. Here's a simple everyday example of how this illusion traps you. Let's say you invest in a stable domestic index fund. You earn a highly respectable 8% over a single calendar year. Sounds great, right? Now, you decide to reward yourself. You plan to buy the latest imported flagship smartphone, or maybe you want to take your family on a well-deserved overseas vacation. But as you go to checkout, you notice a frustrating discrepancy. Last year, that imported phone cost $850. This year, it's $1,000 in your local currency equivalent. Last year, exchanging for $10,000 in travel money required exactly 7,000 units of your currency. Now, that exact same transaction takes over 8,000 units. What just happened in the background while you were busy celebrating your 8% gain? Your local currency depreciated by 15% against the US dollar on the foreign exchange market. So while you made 8% nominally on your little brokerage screen, your actual global purchasing power lost 7%. You are quite literally poorer than you were a year ago, despite having a higher account balance. The number went up, but the physical reality of what that number can extract from the global economy went down. That is the silent tax of currency depreciation. It doesn't announce itself by forcibly reducing your account balance. It quietly erodes the underlying meaning of those numbers while you're not looking. Who is pulling the strings? This brings us to the core mechanical driver of this entire phenomenon. Former U.S. Treasury Secretary John Connolly once famously stood in front of a room of European finance ministers and told them, "The dollar is our currency, but it's your problem." It is a deeply arrogant statement, but it is a profoundly accurate summary of the modern financial architecture. The Federal Reserve might look like America's domestic central bank on paper, but in reality, it functions as the central bank of the entire world. By adjusting the federal funds rate and expanding or contracting its balance sheet, the Fed controls global capital flows like a massive mechanical heartbeat. Phase 1, the flood. When the U.S. economy slows down, the Fed cuts interest rates. They inject massive waves of liquidity into the financial system to stimulate growth. Suddenly, cheap, easily accessible dollars flood the global system. Institutional investors, banks, and hedge funds borrow this money at near zero costs. But they can't leave it sitting in low-yield U.S. accounts. They have to go hunting for yield. So where does this wall of money go? Emerging markets. These regions offer higher baseline growth, significantly cheaper asset valuations, and much better percentage returns. So capital pours in seamlessly across borders. Local stock markets rise sharply on the influx of foreign buying. Domestic real estate booms as credit becomes plentiful. Local currencies strengthen because foreigners are buying them up to invest locally. Everything feels amazing. It feels like a golden age of permanent prosperity. Retail investors look at their soaring portfolios and feel like absolute geniuses. Margin debt increases because borrowing feels practically free, the water level is high, and all boats are rising. Phase 2, the drain. But the economic cycle always turns. Inflation starts to rise in the US, or the Fed decides the economy is overheating. They signal it's time to tighten monetary policy, interest rates go up, the printing press slows down, the cost of capital rises. Suddenly, risk-free U.S. Treasury yields start looking very attractive again. Institutional logic flips overnight. Why take on currency risk, political risk, and market risk in emerging markets thousands of miles away, when I can earn a guaranteed, solid return in the world's reserve currency right at home? So the capital exits, and it exits violently fast, the double hit. This is where the structural damage happens to the unsuspecting retail investor. As foreign capital pulls out of your domestic market, two devastating forces trigger at the exact same time. First, asset prices collapse. Large foreign institutions don't sell gradually. They sell aggressively to lock in profits and repatriate their funds. Because emerging markets often lack the deep liquidity of Wall Street, this massive wave of selling completely overwhelms local buyers. The order books empty out, the floor falls through, stocks crash, and real estate freezes as credit dries up. Second, currency depreciation. The institutions aren't just selling your local stocks. They are taking the proceeds from those sales and immediately converting that local currency back into US dollars. This floods the foreign exchange market with excess local currency while creating massive demand for dollars. The result? Your local currency plunges in value. So now, as a local investor, look at your reality. Your portfolio is down 30% because of the institutional sell-off. Your currency has lost 20% of its global purchasing power because of the FX conversion. Imported goods become drastically more expensive, triggering local inflation. This is not a standard market correction. A correction is a temporary dip in asset prices. This is a systemic wealth compression. It is a fundamental repricing of your country's economic standing on the global stage. The blueprint, the 1997 Asian financial crisis. Let's make this abstract mechanism entirely concrete. Let's look at a historical blueprint. In the mid-1990s, Thailand looked completely unstoppable. It was a textbook economic miracle, a booming export economy, skyrocketing equity markets, and a newly wealthy, highly confident middle class. Skyscrapers were going up in Bangkok at record speeds, fueled by cheap foreign debt, but underneath the shiny exterior, Thailand had a fatal flaw. It maintained a rigid exchange rate pegged to the US dollar, supported by a relatively limited pool of foreign currency reserves. Global hedge funds, analyzing the macro data, saw the structural vulnerability. They realized the peg was an artificial wall that couldn't hold back the changing global liquidity tide. So they broke it. Here is the exact playbook they used. They borrowed massive, unprecedented amounts of Thai baht from local banks. They aggressively sold that borrowed baht on the open market, exchanging it for US dollars. This relentless selling applied immense downward pressure on the currency, triggering widespread panic among other financial institutions. Local Thai investors, seeing the writing on the wall, joined the stampede, desperately trying to convert their own wealth into dollars to protect themselves. The Bank of Thailand tried to defend the peg by using its dollar reserves to buy up the excess baht. But the sheer volume of the sell-off was too great. The central bank literally ran out of US dollars. The defense failed, the government was forced to float the currency, the baht collapsed instantly, eventually losing over half of its total value. Then came the final ruthless move. Having driven the currency into the ground, these hedge funds took their strong, heavily appreciated US dollars and bought back the severely devalued baht for pennies, repaid their original local bank loans, and pocketed absolutely enormous profits. Meanwhile, the reality for the average Thai household was catastrophic. Property values collapsed, and stock portfolios were completely wiped out. Lifelong savings were cut in half in real global terms. People who were completely comfortable one day woke up functionally bankrupt the next. All of this happened without them ever leaving their homes or changing their spending habits. This brings us to the multi-currency defense system. When you understand the sheer scale of the dollar tide, you realize there's only one core principle for long-term survival. Stop thinking in a single currency. You need to fundamentally change your measuring stick. Stop measuring your wealth purely by the number of local banknotes you possess, and start measuring it by the proportion of the global economy you can actually access. Ask yourself this stress test question right now. If my domestic currency drops 20% tomorrow, does my current lifestyle and financial security collapse with it? If the answer is yes, your financial structure is fragile, you are standing on the beach and the tide is quietly pulling out. You don't need to manage $1 billion macro fund to protect yourself. You just need deliberate, calculated diversification across currency exposures. You need assets that respond inversely when local liquidity dries up. Here are the 3 pillars of a proper defense, starting with gold, the ultimate neutral asset. Gold is unique because it isn't tied to the fiscal policy of any single government. It cannot be printed, and its supply cannot be manipulated by an interest rate hike. It is the closest thing humanity has to a borderless global-based currency. When your local currency weakens against the dollar, gold priced in your local currency automatically rises. This happens even if the global dollar-denominated price of gold stays perfectly flat. It is a built-in, frictionless hedge against domestic currency depreciation. It acts as a heavy anchor when fiat currencies begin to drift, which brings us to the second pillar, dollar-priced commodities and resource equities. Hard commodities like crude oil, copper, and agricultural products are universally priced in US dollars in the global market. When you invest in companies that extract and sell these resources, especially resource exporters located in your home country, you create a brilliant macro hedge. These companies earn their revenue globally in strong dollars. Therefore, when your local currency weakens, their dollar income instantly translates into massively higher local profits. Their margins expand effortlessly. You are indirectly tying a portion of your portfolio to the strength of the dollar, bypassing local economic weakness entirely. The third pillar is global investment access. You no longer need to smuggle cash, offshore, or open complex foreign bank accounts to diversify. The financial infrastructure has evolved. Many countries now offer strictly regulated domestic vehicles like locally listed global ETFs, international mutual funds, or QDII funds. These allow retail investors to seamlessly allocate capital into safe haven U.S. treasuries, broad global equity indices like the S&P 500, or dividend-paying international blue chips. Use these tools to gain direct exposure to stronger fiat currencies and foreign corporate earnings without dealing with regulatory gray areas. But how much is exactly enough? To build a genuinely resilient portfolio, you need a critical mass of external exposure. As a general rule of thumb, look at your total liquid assets. At least 15% to 20% of those total liquid assets should be positioned completely outside your domestic currency system. Do not view this allocation as a tool for aggressive growth, and do not view it as a way to beat the market. Think of it strictly as financial insurance. You buy it to ensure your survival when the macro environment turns hostile, and you don't need a PhD in macroeconomic theory to monitor this. You just need to step away from the 5-minute stock charts and start tracking 3 key global indicators, starting with the US 10-year Treasury yield. This is the gravitational pull of the financial world. If this yield starts rising sharply, it signals capital is being heavily incentivized to flow back to the US. It is the early warning radar of tightening global liquidity. Next is the dollar index, which measures the dollar against a basket of other major currencies. A relentlessly strong rising dollar index acts like a wrecking ball for emerging markets. And finally, you must watch your local central bank. Watch what your local policymakers are doing, not what they are saying. If your central bank is suddenly hiking rates to defend the currency, pay close attention. If their total foreign exchange reserves are dropping rapidly month over month, they are in a defensive posture. That is a bright red flashing signal of capital flight. Listen to me, investing isn't a sprint, and it isn't about who runs the fastest during a massive, euphoric bull market. It's about who survives the longest over multiple economic cycles, and the truth is, you cannot control the dollar tide. It is a macroeconomic force driven by geopolitical power dynamics, trade imbalances, and central bank mandates far beyond your reach. But you absolutely have the power to decide whether you are exposed. When that tide inevitably turns, when the liquidity goes out, what happens to you? Will you be the one caught off guard, helplessly watching your purchasing power vanish on a little glowing screen? Or will you be the one already positioned safely above the waterline, protected by a mathematically sound multi-currency firewall? Understanding the macro environment isn't about perfectly predicting tomorrow's stock market movements. It's about structuring your wealth for reality, so that when the fundamental rules of the system shift, as they always do, you don't get crushed beneath the gears. If you want to build a broader, significantly more resilient investment perspective and stop living at the total mercy of single market volatility, subscribe to the channel. Stay informed, stay safely positioned against the changing tide, and I will see you next time.